The first quarter of 2024 delivered a continuation of the global stock market rally that started in October last year, once again led by US tech. However, this quarter, the equity market didn't require lower interest rates to perform, as traders actually pushed out their expectations for central bank rate cuts amidst stickier than hoped for inflation prints. Rather, equities were bolstered by economic data that suggested a still resilient US economy, while financial conditions loosened as confidence grew among market participants. In March, the equity market started to broaden from its recent narrow focus on large cap names, as we saw some of the more cyclical sectors such as energy, mining and financials doing a bit better. Developed market inflation, which had been coming down through all of last year essentially, crept back up through the quarter, and we also saw real interest rates rise. While at the start of the year, markets were pricing in about 7 interest rate cuts through 2024 from the US Fed, that number has now moderated quite significantly. And so we're now looking at only 2 or 3 rate cuts expected, and probably only starting in the third quarter. The US dollar strengthened against most major currencies, gaining nearly 4% over the quarter. This was driven by the rise in real yields. Those real yields had increased on the combination of improved economic outlook as well as concerns about US government spending. And it's only because of the dollar's status as the world's reserve currency that it can get away with increasing its value when there are worries about government spending. Real yields remain elevated, even compared to sort of more than the last decade, basically since the financial crisis. In South Africa, the focus of 2024 so far has been the outlook for our elections. Although the issues around state infrastructure, particularly evident in the electricity supply and port inefficiency, those are still concerns for markets, we have seen some improvement. Most notably, at the time we were filming this, we've actually had no load shedding in 3 weeks. Unfortunately, we suspect this is more driven by a desire to paper over cracks pre-election than a genuine change of fortune at Eskom, but it's encouraging nonetheless. Heading into the elections, we expect the ANC to garner somewhere between 42 and 48% of the vote, and thus we expect it will need to form a coalition to be able to govern. The key unknown, of course, is just how much of the vote the new MK party will win. Despite some recent commentary suggesting that'll be over 10%, we think that the party will more likely be in the kind of 5 to 8% zone. But overall, we think that markets will respond better to a scenario where the ANC gets above 45%, as then it won't have to make major concessions to any coalition partner to form a stable government. In the US, the sharpest contraction in money supply in over 60 years is having actually a far smaller impact than one might expect on that economy. Yes, there are pockets of concern, but overall, the US economy remains quite healthy. We know that monetary policy works with lags that vary by cycle. And in this cycle, high government spending, excess savings, and fixed rate home loans have actually slowed the transmission of that tighter monetary policy to the man in the street. So he is not being squeezed as much as in similar sized prior cycles. We do still have inflation in the States that is above target, and that labor market has not quite reached equilibrium yet, although quite high immigration is helping that out. Bond markets got a little bit ahead of themselves in late 2023 and maybe January this year, as the narrative around the Fed cutting rates took over, but this certainly reversed through the rest of the first quarter. Really, to us, this illustrates the uncertainty of the appropriateness of the current monetary policy that you're seeing in the market, and of course the uncertainty about the future path of interest rates, which will of course have a significant impact on asset class performance. So in that kind of environment, appropriate diversification remains vital, irrespective of your investment mandate. 2023 was the year of easing supply constraints, which, together with China's economy being out of sync with the West's and lower energy prices, altogether those factors allowed inflation to cool last year. Those tailwinds aren't really with us this year in 2024. So whatever the macroeconomic environment brings in 2024, as always, our focus is on constructing portfolios for our clients that are robust to a wide variety of potential outcomes. In terms of asset class performance, US equities dominated the first quarter of 2024. The MSCI World and S&P 500 indices were up about 9% and 11% respectively in the first quarter, and European stocks split the difference, rising 10% in dollar terms. The MSCI Emerging Markets Index, that lagged global averages, that was up only about 2%. China was largely to blame there, but even India, that's been doing very well, was up less than developed markets. From a style perspective, the momentum factor performed best, rising over 20%, while growth was up 10% and value was up about 8%. Global equity markets remained narrow over the first 2 months of the year, but they did broaden in March. From a sector perspective, the technology sector showed less rates sensitivity than usual, so that was up about 12% over the quarter, while financials and energy also performed quite well. By contrast, global listed property, that did respond to these higher bond yields, that fell about 1% in the quarter. Global bonds themselves, they started the year on the back foot, losing 2% in the first quarter, and they're only up 0.5% over the last 12 months. Apart from sticky inflation, we're also seeing signs of the market demanding a greater reward for taking longer-term risk with government bonds, and that's kind of, I suppose, in light of high current and planned US budget deficits. In the commodity space, oil rose 10% over the quarter on the back of increased tension in the Middle East, but gold for us is a fascinating asset right now. Its price was up about 8% in the quarter, reaching new all-time highs, despite the fact that the expectations for rate cuts were pushed out materially. Normally that would be negative for the price of the metal because it keeps the holding costs of gold high. So in our view, this is the function of a few different factors, but clearly geopolitics is playing a role, and central banks, including China as the biggest, increased their buying of gold. As I mentioned earlier, around the US bond market demanding higher real yields, given concerns about government spending, it does seem that some of that nervousness is showing up in the gold market with increased demand there. When looking at South Africa, the rand was less volatile than in recent times, with our currency ending the quarter down 3.5% against the dollar to end the quarter at about 18.88 rand. Our local equity market, unfortunately, underperformed its emerging market peers. That fell 6% in dollar terms over the quarter, and the number only looks marginally better when expressed in rands, with the JSE All-Share Index down 2% in local currencies. Within our market, financials gave back their good performance of the fourth quarter of last year to end the quarter down around about 7%, while resources and industrials were marginally up. Our local bond market declined 2% in the quarter, while cash gave you a positive 2% return. The house view equity model's performance over the first quarter was encouraging in relative terms, outperforming its benchmark, but this didn't really compensate for the overall market's decline. Over the last 3 years, this portfolio has returned 9% per year after fees, which is about 1% per year ahead of the benchmark, and more than 2% per year ahead of the average peer. So far in 2024, our rand hedge exposure has helped us with British American Tobacco, Anglo Gold and Richemont, helping relative performance, while Netcare and SPAR acted as drags. The house view portfolio remains in the top quartile of its peer group over 2, 3 and 10 years. Our worldwide equity portfolio lagged its benchmark slightly in the first quarter, given the narrow global market I spoke about earlier. Although this portfolio at least delivered a positive return of 2% in rands for the quarter, it was behind its target. While this portfolio has healthy exposure to some wonderful growth businesses like Google and Microsoft, in general it is more tilted towards defensive names. The changes we made to the international part of our worldwide portfolio back in December to provide a bit more balance to our global exposure do seem to be working very nicely so far. If we then move across to our Regulation 28 multi-asset portfolios, the short-term performance was a little bit disappointing. The balanced, moderate balanced and conservative portfolios were all marginally behind their benchmarks for the quarter after fees, but they do remain ahead of those benchmarks over 2, 3, 5, and 10 years. The portfolios benefited from positive asset allocation calls, but this couldn't outweigh the relative underperformance of the offshore equities component. In terms of activity in the portfolios, we deployed some dry powder by adding to Naspers in January, which is working well so far. We also took advantage of the buyout offer for MultiChoice to exit that business. In the balanced portfolios, we adjusted our international equity exposure to be a little bit less defensive as well. Overall, our positioning across our portfolios remains slightly conservative given our concerns around valuation in global equities. When we look at global equities, those indices are materially higher than average on a forward-looking price-to-earnings multiple basis, while only the US economy is doing well. The rest of the world isn't having a particularly good time. The market, though, is pricing in accelerating profit growth in 2024, and we think that's going to be quite hard to achieve given our expectation that overall economic growth will slow this year compared to last year, not just in the States, but in the rest of the world as well. If we shift our attention to South Africa, we have quite a different situation. Our market is looking cheap relative to both its own history and to global peers. But unfortunately, there are clear reasons for this, given the difficulties at state-owned enterprises in our country. In the weeks ahead, we expect SA's 7th democratic election to create some market volatility, and potentially that can create some interesting opportunities for us. We expect another year of anemic growth in South Africa, but we remind clients that we have been preparing for this for some time by tilting our portfolios to make them more robust to a low growth environment, both through a more defensive equity selection as well as through our asset allocation. South African stocks should probably grow better than the economy as a whole as they improve off the low base that came thanks to heavy load shedding last year. Global equities also appear expensive relative to global bonds. The premium that investors are being paid to take the additional risk associated with holding stocks relative to bonds is now actually at a 2-decade low. So by being more circumspect now, we are hoarding a little bit of so-called dry powder that we hope to deploy into more risky assets once prices become more attractive in future. So in conclusion, we still believe that we are in the latter stages of the investment cycle. That means we shouldn't allow recent good performance from markets to make us complacent. With multiple possible macro outcomes, we will continue to focus on building well-diversified portfolios for our clients that are robust to a variety of potential economic scenarios.